Let's jump right in. Welcome to this explainer. Today, we're unpacking a really calm, super methodical approach to evaluating a real estate investment property. Look, if you've ever felt totally overwhelmed by all that high-pressure hype and those flashy sales pitches you see floating around out there, you are definitely in the right place. We're going to strip all that noise away. We're going to look at the numbers exactly how a seasoned pro does, focusing purely on clarity and actual practical understanding. And honestly, the whole philosophy of a trusted advisor boils down to this one incredibly powerful idea. Education always comes before persuasion. The goal here isn't to sell you on some specific outcome or, dazzle you with a bunch of complicated jargon. Not at all. The real objective is to leave you better informed, way more confident, and significantly less overwhelmed, so you have the exact tools you need to make wise decisions for your own financial future.
So here's our quick roadmap for today's explainer. 1. Education before persuasion. 2. Evaluating the asset. 3. Adding the loan. 4. Time and opportunity. And finally, 5. Wise decisions.
All right, Section 1. Education before persuasion. Building the foundation.
Before we even think about chasing the absolute biggest return or jumping headfirst into a deal, we've got to understand that trust is earned through clarity, not some manufactured, hype-driven certainty. This is exactly why we evaluate the numbers strictly based on current reality, not blind optimism. We're not going to magically tweak the spreadsheet just to prove a point. We want to know exactly what the property is doing right now, today, without depending on some perfect tomorrow to make the deal actually work.
Moving right along to Section 2, evaluating the asset, looking at the property itself.
Okay, let's get into a real-world example. We're going to evaluate a duplex with a purchase price of $280,000. Now, for the sake of this example, let's assume this duplex is fully renovated and totally move-in ready. Why does that matter? Well, buying a turnkey property is a very specific trade-off. We're basically saying we'll accept a slightly lower initial return in exchange for a property that needs way less immediate labor, and hopefully spares us from those nasty surprise maintenance bills right out of the gate. So let's crunch the numbers. Say one side rents for $11.25 a month, and the other side goes for $11.75. That brings in a solid $27,600 in gross rent for the year. Pretty great, right? But hold on, that's not pure profit. From that gross amount, we absolutely have to subtract the necessities. We're talking property taxes at about $3,300, insurance around $1,600, and professional property management fees taking an 8% cut, which is roughly $2,208.
After subtracting those initial operating expenses, what's left? We're looking at an annual net income of $20,492. But remember, and this is absolutely crucial to keep in mind, this number is before we've even factored in the mortgage and before we've set aside a single dime for future maintenance or potential vacancies. So how do we know if this is actually a good deal? Well, we apply a really calm, logical two-step filter. Step 1, does the property itself produce an acceptable return completely on its own, entirely ignoring how we plan to pay for it? And then Step 2, does it cash flow with the actual financing we can get in today's market?
Let's hit Step 1 first. We take that net income, the $20,492, and divide it by our $280,000 purchase price. That gives us a 7.3% return on investment before a bank even enters the chat. Basically, it tells us the property is fundamentally healthy on its own 2 feet.
Now for Section 3, adding the loan, the reality of financing.
Since most of us aren't just dropping cash for the whole shebang, let's look at the financing reality. If we put 20% down, which is $56,000, we need to finance the remaining $224,000. Let's say we're in a higher interest rate environment and lock in a 7% fixed rate over 30 years. That makes our monthly principal and interest payment roughly $1,490. Multiply that out and you're looking at nearly $17,900 in debt service over a year.
All right, here's the reality check. When we subtract that massive annual debt service from our net income, we are left with a surprisingly small number. We're talking just over $200 a month in positive cash flow. Which brings up a very real, totally reasonable question. Why on earth would you tie up $56,000 of your hard-earned cash and take on the headache of managing a $280,000 asset, literally just to pocket $200 a month? It sounds kind of crazy, right? But this question perfectly shifts our perspective from chasing short-term cash to actually building long-term wealth.
And that brings us to Section 4, time and opportunity, the hidden benefits of holding real estate.
Because when you zoom out over a longer horizon, something truly fascinating happens.
See, your fixed mortgage payment of $1,490, it stays exactly the same for 30 years. But the economy around it doesn't. Inflation is constantly at work, effectively shrinking the real-world burden of that fixed debt, while historically rental incomes just keep rising. So a mortgage payment that feels a little heavy today is going to feel surprisingly light 10 years down the road compared to the rent you're pulling in.
And meanwhile, you've got the silent superpower of amortization working for you. Every single month, a chunk of that fixed mortgage payment isn't just vanishing into thin air. It is actively paying down your principal loan balance. Put simply, just by paying rent, your tenants are quietly building your equity in this asset, month after month, year after year.
So the big takeaway here? Sure, the initial cash flow return was pretty small in year one, but that's literally just the starting line. Over decades, rent growth, inflation eating away at the debt, and that constant principal paydown will completely transform this asset. It's like a snowball. It just grows stronger and more powerful the longer you hold on to it.
The golden rule is this: we buy the property based strictly on today's numbers, but we'll own it through decades of changing dollars. Now, if interest rates eventually drop, hey, you might get the chance to refinance, slash your payment, and massively boost your cash flow. But, and this is a huge but, you never ever depend on that future rescue because you bought a deal that already made sense on day one. A refinance is just a nice bonus, not a lifeline you're desperately clinging to.
Let's wrap it all up in Section 5, Wise Decisions, putting it all together. Ultimately, when you look at a well-educated investor, they follow a pretty simple playbook. They buy based on today's reality. They make sure the asset is fundamentally solid without a loan, and then they verify it still cash flows with the financing they can actually get right now. They use long-term, fixed-rate debt super responsibly. They let time, inflation, and amortization do the heavy lifting to build equity. And they never bank on a future refinance to magically fix a bad deal. At the end of the day, real estate investing is not some flashy get-rich-quick scheme, and there is no magic formula. It's all about acquiring a well-purchased, productive asset that just gets better and more powerful over time. As your equity builds up and your cash flow improves, you get flexibility, you get options. It's about making a really wise, patient decision today that steadily builds long-term freedom for your future. As we finish up this explainer, I want to leave you with one final, super important question to chew on before you make your next move. When you look at your own financial goals, your family, and your long-term plans, what will actually help you make the wisest decision for your future? Take your time, trust the math, and remember, real understanding is, without a doubt, your absolute greatest asset.